Stable income is a key consideration for any retirement plan. In a previous video, we explored the tips ladder, and today what we're going to do is explore annuities for lifetime income streams. So Spencer, as we talk about annuities today, one of the key considerations we need to make is that annuities aren't for everyone. For some people, it makes a lot of sense, but for others, it really doesn't make any sense. So to come back, we want to start off, and we just want to say that there are key risks when we think about longevity in retirement and income in retirement. So our key risks are credit. Is the company going to be around, or is the institution offering the funds going to be around for a long period of time? There's inflation risk. What does it do when the market goes up or down? And how does my purchasing power affected therein? And then longevity. How long am I going to live? If a client told us I plan to die tomorrow, then it's going to be a very different conversation than someone saying, I want to live well into my hundreds. So what are some other just basics of annuities that we need to really consider before we really dive in here?
Well, annuities at their core are a contract between an investor and a insurance company. So we always chuckle when we say this, but Bill Gates is not buying an annuity. He doesn't need an annuity for his financial plan. An insurance company, every one of them that's out there is good at making money. So they're going to provide a set of benefits relative to the investment that's made or the contract that's purchased, but on average, they're going to do well on it. They're going to make a little bit of money on average on every contract that they sell, otherwise they wouldn't engage in it. So we've got to remember that this is not a solution for everybody out there. When we think about it, there's also a lot of different ways that these types of contracts are structured. So one of them would be known as a single premium immediate annuity. This is the plain vanilla example, but let's just say that we want to have a guaranteed income stream for our lifetime. We don't care about step-ups over time, those cost of living adjustments. Let's just say that we're very comfortable with a fixed rate over time. Well, we take a lump sum of resources and we enter into a contract with that annuity company, that insurance company. We hand over that lump sum and then they covenant to pay us every month or year, whatever the cadence is, pay us for the remainder of our lifetime. That is a single premium immediate annuity, kind of just at its core there. Or there are some that are out there that could also pay for a set period of time or have some other kinds of provisions that are in there. But if we're thinking about solving for lifetime income, then we would trade that lump sum for a consistent annual, let's say, payment over time that would make sure that we've at least got some income above and beyond what Social Security or other pension income might be paying us.
Right. And so as we come back to this, we look at those three risks that we talked about last week. And credit risk, that's not on the table for the US government, by and large. Inflation protection, when we talked about tips, they helped and protect us against inflation. But there was a longevity risk there because you can only build a tips ladder out for 30 years.
Right.
When we look at annuities, it's kind of on the flip side. You can get some of that inflation protection with some of them. You can get some of the longevity, but you're investing with a company. The insurance contract that you sign is between yourself and the insurer. So when we talk about these as guaranteed income streams, it is the insurer's promise to pay.
Right.
It is not us as the advisor saying you are guaranteed the income. It's the insurance company that says we are guaranteeing this as long as we are around.
Right.
So if the company goes under, then your investment is now no longer viable. That promise is now broken.
Right.
And so that's really something we need to think about when we think about these annuities. The other thing is it's a lot like your homeowner's insurance policy. It is pooled risk across a broad spectrum of people.
Right.
And so if an insurance company has 1 million contracts for homeowners insurance, they know that somebody is likely going to have a claim, whether it's a fire or a tree falling on their property or something that happens. But what they're not expecting is everybody to have a claim in the exact same year.
Right.
And so they pool the risk over a broad group of individuals, knowing that at some point in time, they will have to pay. And go ahead.
And that's hits the nail on the head for that first example that I gave. You're going to have some people, if you have 1,000 people that enter one of these contracts at age 62, you're going to have a handful of people that die in their 60s. You're going to have more people that die in their 70s. You're going to have a lot of people that die in their 80s, a few people that die in their 90s, and a couple of folks that make it beyond age 100. Mm-hmm. So there's that pooled risk where if you're comfortable saying, okay, if I only live another year, that's the income that I get, I'm surrendering that lump sum. But I'm more concerned that maybe I live 40 years and I need to still have income out there, which a TIPS ladder might not be able to provide at that same level.
Right. So one of the other highlights of annuities is the fees can often be higher than traditional investments. And so we just want to say that on the front end, that when you enter this contract, you have to pay for the insurance. You are paying for that benefit that you could receive in 40 years, but you have to pay for it. So
well, and these types of contracts are more difficult for many folks to dig into the details and understand. They can feel more opaque. There can feel like there's more gotchas that aren't explained. And so if you're moving in this direction, you really need to look at the fine print to understand what's going on here. Because the headwind can be very significant, or it can be less significant depending on the other terms of the contract.
So let's just go ahead and talk about some of the benefits of annuities for retirement income. One of the key ones that we surface with clients is within a broad retirement plan, it could make sense to allocate a little bit of resources to get that guaranteed income stream that the insurer is going to pay every year. And some of these even have cost of living adjustments. So they say, hey, if the investments go up, your benefit will go up every year. If the account value goes to zero, we will continue to pay, even if that benefit baseline, if you literally have no more value, the insurance company will continue to pay. The other one is some have long-term care riders. We talked about this in previous episodes, but they may say, hey, if you qualify for long-term care, we will pay twice the amount of your annual income for a certain period of time. So there are some benefits here for that insurance cost.
For some contracts.
That's
what we always have to come back and say, these are kind of a choose your own adventure. There are so many different types and flavors of these that are out there. But there are some that do have those really nice long-term care riders that are built in. The thing that we always say, though, is there's a cost to those. So sometimes there's an elevated cost. But if we kind of think about the three buckets that we might have here, again, we have some kind of just guaranteed, plain vanilla lifetime income that if you move into a contract like this, you surrender the value that you put in. There's another type that many people would call fixed indexed annuities, where you put resources in. There's an interest rate that you are credited over time based on a number of different factors. You could look at an index itself or grab the fixed rate there, but there's usually also some fees. And so that rate of return that you might receive is going to have some headwinds against it. What the annuity company oftentimes in these fixed indexed annuities, though, will do is they will incentivize you to defer the lifetime distributions for a number of years. So every year that you defer, what they'll say is, well, we'll allow you to take out more going forward. So it might be, 0.4% or 0.5% or some other number that they are incentivizing you. So they say, well, if your income would be $10,000 on an annual basis, if you took it day one, well, we'll give you $10,500 if you defer a year, and we'll give you $11,000 just as an example if you defer 2 years in some of these contracts. Again, every one of them is different, and so don't take that for more than just an example here. So that would be a fixed indexed annuity. And to your point, the goal there actually is to see the account go to zero. We like to see that account go to zero because that means that clients have been taking out that income stream, and as long as they've taken out the income stream within the prescribed values, within the course of the contract, and its lifetime guarantee or lifetime reliable income that it says that it will provide, then if the account value goes to zero and they're still getting paid, why, that's a nice place to be. Because even though there's no more value that they would have in a surrendered contract, they might be getting paid for 10 or 15 or even 20 years, that reliable income stream. And for some of them, that that amount continues to move up
Right.
over time with the value of some of the index growth there. So that is that fixed indexed annuity, kind of flavor that we talk about there.
So we've covered two different types of annuities.
Mm-hmm.
There's, again, like you said, there's a lot of different variations out there for reliable income.
Mm-hmm.
The first was that single premium. The
Mm-hmm.
next was the fixed premium, or the fixed annuity, fixed indexed.
Mm-hmm.
What's that third one, the variable annuity? Talk us through that a little bit.
Yeah, variable annuities, the idea is basically you can put investments in, you can have them in sub-accounts, and these sub-accounts then are invested in some kind of mix of stocks, bonds, other kinds of investments. So there are some companies that are out there that will let you invest very aggressively in these sub-accounts, and they'll still provide some level of guaranteed retirement income there. So you might be able to invest, say the idea would be you could invest in stocks that are much more volatile, but you could still get a lifetime income stream. What we see in the marketplace, of course, is that lifetime guaranteed income stream is not going to be at the same level of those first two that are out there, the single premium annuity or the fixed indexed annuity. Usually those will guarantee a higher level of lifetime income, or they will provide that based, again, that the company is still in business, over time. But that variable annuity, for some folks who say, well, I'd like my investments to still be very aggressive, but I'd like to have, kind of a lower level of guaranteed income, sometimes that can be helpful. So you're kind of invested in a way that's aggressive, but you're buying some insurance such that if those aggressive investments drop, that at least you've got some level of income over the course of your lifetime. Now, the caveat there is that insurance amount can be significant.
Mm-hmm.
So you don't get that benefit for nothing. You have sometimes well north of 1% on an annual basis just for that living benefit rider. And then with the other expenses, you might be north of 3% annually in terms of all of the expenses put together in those variable annuities. So you think about it, and the insurance company is going to say, well, we're going to come up with products that we find will meet demand in the marketplace, but we're going to make sure that we price them in ways that we still make money. Right. So over time, that can be a way that clients can find some value in, that they can stay relatively aggressively invested, but they have to be comfortable with all of these other trade-offs that they're facing.
Yeah, so Spencer, as we think about taxes on non-qualified annuities, when we think about a traditional stock account or an individual account, you're taxed every year on dividends and capital gains annually. Mm-hmm. How is that different than an annuity?
Well, first let's think IRAs, Roth IRAs. You can put investments that are annuities. You can put them in those types of accounts, and the taxation is not different materially there. So we, again, just think about the non-qualified side of things that you're addressing. And on the non-qualified side, an annuity, you put resources in, and if the account gains in value over time, you're not paying tax on those gains until you take the withdrawal. The withdrawal, though, can be more punitive, or it can be less punitive depending on when you're taking it out. So you don't have required distributions from that non-qualified account over your lifetime. So that can be kind of a nice thing in that, you might put the resources there and they grow and grow and grow, and they're not taxed for 20 years. Well, you can have compounded gains over that time, and particularly if it's interest income that would be taxed at ordinary income levels that are higher than those dividend levels, then that can be a nice spot to put some of those non-qualified resources, again, just because you get some tax benefit to it. But once you start to make those withdrawals, you're taxed on a LIFO basis. That's last in, first out. The last resources that are put into that contract are the gains. Mm-hmm. So let's just say you have $100,000 in the investment, you put it there, and it's there for a long time. It's there for 30 years. That $100,000, let's say it grows to $500,000. Well, you have $400,000 of gain in there, and as you take resources out, you're going to be paying on those distributions as ordinary income until you get back down to that last $100,000 typically. Now there's certain situations where indeed you can actually take out resources pro rata. Your beneficiaries sometimes can do that where, if you have $500,000, why 20% of your distributions might be taxed as a return of basis rather than ordinary income. But generally speaking, you're going to take resources out and they're going to be taxed at an ordinary income level until you get back down to that initial investment that you made. And then you've got return of cost basis return of basis there that you're not paying tax on.
All right, so let's talk about some of the risks that are associated. So we've talked about the company risk. You're entering an insurance contract with a company. If the company goes under, the contract's broken. Go ahead.
So, and one of the things that I think is so important to grapple with here is these companies are very strong, many of them. They might be very, very highly rated. The companies that we would look at with clients would be very highly rated. But we can never predict the future. So, in 2019, before the pandemic, nobody had on their radar screen what would be going on in 2020 with the global lockdown and all kinds of different, financial elements that put a lot of stress on companies that were unexpected. Nobody expected Boeing to be kind of on death's doorstep headed into the next year, but that's what can happen. So we could expect several of these types of events to happen over a 30 or 40 year time frame. Think about the global financial crisis. Nobody, expected the level of kind of devastation that happened to financial firms in that 2007 to 2009 time period. So we look at it and say, okay, well, this insurer is really strong now, but just because they're really strong now doesn't mean that there's any kind of guarantee that they're going to be there in 30 or 40 years. Right. We hope so, but again, not a guarantee.
Right. Yeah, exactly. And there's another risk to this as well when you think about interest rate risk. And so let's presume that if you have a client that decides, okay, I want to put it into a fixed indexed annuity and I'm going to invest and it's a 2% guaranteed rate of return. Well, if interest rates rise to 4%, 5%, 6%, then you're still going to get that contract level because you signed the contract with that insurance company, which then can be punitive because sometimes there's also surrender fees. Right. So if you wanted to surrender your contract because insurance rose and you can now get a higher amount, well, now you've got maybe a 5%, 6%, even up to 7% that is a surrender fee, and then market value adjustments. So again, insurance companies are really good at writing these clauses into the contract so that they can make money. Right. They know that when you invest with them, they're going to invest for a long period of time so that they can hedge their bets. But again, if interest rates rise, you're exposed to that risk. Even though you have some guaranteed income, you now are leaving some money on the table potentially.
Right. Well, and we have to understand, like you said, that if they're entering into a very long-term contract, if they're guaranteeing income, maybe for 4 decades or more, potentially, then they have to, if they're putting resources in particular places, they've got to know that you're in it for the long term as well. So there are surrender charges with a lot of these, and they're in some ways understandable because, again, if they invest it very, very long term and then something happens and the interest rate environment or bond market changes drastically in the first quarter, then you can't expect to just get all of your funds back because the investments that they made that are maybe 30 or 40 year investments, they've potentially suffered some really significant losses. So they've got to hedge their bets, as you talked about there.
Yeah. So the other thing is we can think about just market risk in general. If you decided to go into the variable annuity contracts and wanted to have some funds invested in a stock, and several years in a row, the market is only up or down 1 or 2%, and your fees are 3% or 2%, then you could be even further down. Right. And so we just have to accept that there is additional risk. And if you're paying an additional level for insurance, that risk, that drop in the market could feel a little bit more substantial in those variable annuity products.
Absolutely. Yeah.
So let's talk about some scenarios where annuities may help. The first we've talked about, if you live in your late 80s, and the account value goes to 0 and they keep paying you, that's a really good benefit. Right. You've received what you wanted. Another one is just thinking about clients that need that little kick to live and give. If there's a little bit of hesitation of, well, I don't want to see the money run out, Annuities could help because then it allows them to say, hey, you've got this reliable income stream that's being paid by this company for the rest of your life. So you can utilize the resources to really live and give, or be a little bit more aggressive in a different type of investment.
Right. An example might be, if a client has $1 million and really all it takes to be able to get the reliable income that they need to just use $400,000 of that to be able to have an insurance company give them, that income, that month to month or year to year income. Why the remaining $600,000? Well, now they've got it, and they could be using it to live and give, as you talked about, in ways that they just might not be comfortable with without that encouragement that, okay, I'm seeing that reliable income stream.
Yeah. Well, Spencer, as we think about how annuities may not actually help, and we just look at the inverse of those last two scenarios,
right,
where if you die before the account hits zero, you haven't really gained a whole lot from that insurance contract. That's really where we see the benefit, is living out past that place where the account hits zero. The other thing is you don't need the steady income stream. If you are not having a problem withdrawing resources, then paying for that insurance doesn't make a whole lot of extra sense. So we just need to realize that when you think about an annuity, it needs to come within the comprehensive financial plan. Does this make sense for your plan? And really that's where we would say you need to come back with your financial advisor and talk about, does this make sense for me? It doesn't make sense for everybody. And that's where the reality of Baskin-Robbins type 31 flavors of ice cream, there's a lot of different flavors of annuity contracts. So we would say, this isn't a guaranteed stamp. Yes, you should do it, but we need to look at it comprehensively. So with that, we hope you enjoyed this episode, and we'll see you again next time. If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.